The latest US inflation figures are out and markets are loving them. Today, the Bureau of Labor Statistics reported that core consumer prices in the US rose by 0.2% month over month from November to December, which is a tad bit lower than the 0.3% increase that economists were expecting. In response to the news, the S&P 500 jumped 1.8%, while the iShares 20-plus-year Treasury bond ETF TLT, a very popular bond ETF, jumped by 1.7%. Now, does this eliminate all of the inflation worries that have been bubbling up over the past few months? No. But it is an encouraging report, and it takes some of the more dire predictions about how the Fed will have to hike interest rates to combat inflation off of the table, at least for now. I'll talk more about the stock and bond markets in a second, but let's quickly take a look at the details of the CPI report. Like I said, there was a smaller than expected 0.2% increase in core consumer prices from November to December. But a lot of people also like to look at the year-over-year figure, which compares prices in December 2024 to prices in December 2023. That year-over-year number was 3.2%, which is a reduction from the 3.3% in November. So that's good, it went down. But it's still above the Fed's 2% target for inflation. As you can see in this chart, on a year-over-year basis, the core CPI has been growing at a rate just above 3% for the past 6 months. That's good in the sense that inflation is well below the highs of 2021 and 2022, but it's still a little bit too high compared to the Fed's target. Okay, so that's the state of inflation today. We're basically in the same place we've been over the past 6 months. Inflation is down, but it's kind of stalling at these levels that are slightly higher than the Fed wants. When you combine that with the strength that we've seen in the job market and the overall economy recently, expectations are that the US Central Bank is going to stop cutting rates for now. When the next FOMC meeting rolls around on January 29th, the Fed is probably going to sit back and do nothing, which is different than what we've seen over the past few months. From September through December, the Fed cut rates 3 times for a total reduction of 100 basis points in the federal funds rate. But if you look at futures markets and other market-based indicators, they're suggesting that that's all we're going to see in terms of rate cuts for now. We might see one more rate cut this year, maybe, but probably not even that if the economy stays strong and inflation stays where it is. But that's not really a big issue. I think from an investor perspective, that's totally fine. I'd much rather have a strong economy and no Fed rate cuts than a sharply slowing economy and Fed rate cuts. If you want the stock market to go up, you want to see the economy grow and you want to see corporate profits rise. Granted, you don't want to see an overheating economy where inflation shoots back up, causing the Fed to hike interest rates again. But like I said, we don't see that in the data right now. Inflation is a little bit too high, but it's not accelerating. So that might be why the stock market surged today. We're in an environment where growth is strong and inflation is relatively contained. So with all that said, let's take a quick look at the charts. The S&P 500 is now back to 5950, which is 2.3% below the all-time high from December. At the low earlier this week, the index was down roughly 4 to 5% from its highs, which is the type of pullback we see multiple times every year. Now, this can change at any moment, but right now we don't seem to have a catalyst that sparks a bigger sell-off, like 10% or more. For context, the last sell-off of that magnitude was all the way back in October of 2023, so it's been quite a while. I do think we're going to get a double-digit correction sometime this year, but who knows when that's going to happen. In the meantime, we'll see if the S&P 500 can move back up to its all-time highs and potentially make new highs after Trump officially becomes president again. Here's another chart I want to show you. This is a chart of the 10-year Treasury bond yield. It was close to 4.8% earlier this week, which was the highest level since late 2023. After the CPI report came out, the yield dropped around 14 basis points. This is going to be a very important chart to keep your eye on. I think the stock market is comfortable with rising yields on the 10-year as long as they don't go above 5%. Because after all, we've already seen yields at these levels over the past couple of years, and they haven't derailed the economy. But if the 10-year yield breaks those 2023 highs and goes to 5.25%, 5.5%, or even 6%, then investors could start to get nervous. So we'll see what happens. I'll be posting more videos about this stuff, so be sure to hit the subscribe button, and I'll catch you in the next video.